Okay, so today we're doing a deep dive into something pretty powerful in the corporate tax world.
Hmm.
IRC Section 250. That's the Foreign Derived Intangible Income Deduction, FDII for short. If you're running a domestic C Corp, one that exports goods or, importantly, services, this one's for you. We're talking about getting your effective tax rate down to just 13.125% on certain income.
Yeah.
That's a huge break.
It really is. And it's interesting to think about why it exists. It didn't just appear, right? This came out of the 2017 Tax Cuts and Jobs Act. It's basically the carrot.
The carrot. What's the stick then?
The shtick is GILTI, the Global Intangible Low-Taxed Income Regime. So GILTI kind of discourages parking income offshore. FDII does the opposite. It rewards you for keeping valuable IP and the resulting export income right here in the U.S.
Right. Okay. So it's about encouraging domestic activity for foreign sales. But how does that actually work? I mean, I know the calculation's complex. Maybe we skip the full 4 steps.
Yeah, probably best. Let's focus on the core idea. It starts with your overall income, your deduction-eligible income, or DEI. You strip out some things like, foreign branch income.
Okay. Got the starting point.
Then comes the really clever part, or maybe slightly strange part, depending on how you look at it. The IRS essentially deems what part of your income comes from intangibles, your IP.
How do they deem that?
They start with your tangible assets. Think buildings, equipment, stuff you can touch. What the tax code calls QBAI, Qualified Business Asset Investment. They basically say, okay, a normal routine return on those physical assets would be 10%.
10%. Seems a bit arbitrary, doesn't it?
Well, it's a baseline. It's their way to separate out the standard profit from just having stuff versus the extra profit that comes from your unique ideas, your patents, your brand, your intangibles. So anything you earn above that 10% return on your tangible assets. The IRS says, aha, that must be from your intangibles. And that income, the DII, is what potentially qualifies for the big deduction.
Okay, so first hurdle. Calculate that intangible income based on what's not from tangible assets. Got it. But then it has to be foreign derived, right? That's the FD and FDI. How do you prove that?
Exactly. That's the next critical piece. 2 main tests. First, the sale or the service has to be to a foreign person, not a U.S. entity. Second, it has to be for foreign use.
Foreign use.
Yeah.
Okay, for goods, that seems straightforward, like ship it abroad, it gets used there.
Generally, yeah. Shipping manifests, things like that help. But for services, that's where it gets interesting.
Right.
And where a lot of planning opportunities lie.
Services, right.
Yeah.
Because you could perform the service entirely here in the U.S.
Absolutely. The key is where the benefit of that service lands. If the benefit accrues outside the U.S., even if the work happened here, it can qualify.
Can you give an example of that? It feels a bit abstract.
Sure. Think about, say, a U.S. company doing R&D work. All the scientists are, I don't know, in California, but they're doing this research under contract for their foreign parent company, maybe in Ireland or Switzerland. The IP developed, the manufacturing know-how. The benefit flows to that foreign parent's operations, even if a final product eventually comes back to the U.S. market. In a case like that, we've seen that R&D service income qualify 100% as FDDEI, foreign-derived deduction-eligible income.
Wow. Okay, so R&D performed stateside for a foreign entity. That's a potential gold mine.
It can be, yeah, especially for tech, pharma, any R&D heavy sector.
This sounds amazing, almost too good to be true. Which makes me think, what's the catch? What's the biggest risk here?
One word, documentation.
The details.
It's all about proving that foreign person status and, crucially, the foreign use to the satisfaction of the secretary. That's IRS language for you better have proof, and it needs to be contemporaneous documentation.
Meaning you need it at the time of the transaction, not something you scramble to pull together 3 years later when the audit notice arrives.
Precisely. You need your WABNs from foreign customers, your contracts clearly stating scope and benefit location for services, proof of where goods were ultimately used. It needs to be part of your process from day one.
Okay, so let's wrap this up. The big picture is, FDII is a seriously powerful tool. That 13.125% rate is fantastic, especially if you look beyond just goods to services. But you absolutely have to nail the documentation side, otherwise the whole thing falls apart.
That's the crux of it. And maybe one final thing for you to think about. That amazing 37.5% deduction, the thing that gets you to the 13.125% effective rate, isn't permanent. Right now, it's scheduled to drop quite a bit. The deduction rate goes down to 21.875% for tax years, starting after December 31, 2025.
Wait, so the tax break gets smaller soon?
Significantly smaller, yeah. Which means 2025 becomes a really, really important year. If you have potential FDII, you might want to think about accelerating income into 2025 to maximize this benefit while it's still this large. Something to explore.